Sanjeev Prasad joins us on the show. He's the MD and co-head, Kotak Institutional Equities. Sanjeev, hi, good to be speaking with you. Well, I'm reading your note this morning, and while a lot of people are worried about the correction that we have seen, you are calling it what correction at all? You're not happy with the kind of downtick that we have seen so far? Still frothy in pockets?
Absolutely. It's not really a correction. If you look at how much the markets have fallen from the peak levels, I think they're down between 4 to 7%. If you look at various indices, large cap is down about 7%, mid cap Nifty index is down about 6%, small cap is down about 4%. Last 1 month, about 4.2%, respectively. Not really a correction in that sense. And the valuations across the board are, I would say, ranging from fair to full to frothy. So beyond banks and a few names here and there, we just struggle with the valuation. There's not a lot of upside left to some of most of our stocks here in terms of the price and value proposition at this point in time.
Sanjeev, so in the mid and the small cap space, would you also say that the extent of the correction has been little? Because you can argue back about Nifty and say, okay, 10-12%, which is not a very meaningful correction. In hindsight, it's almost like a running correction. But that is not the case in mid and small cap stocks. I mean, they've corrected on an average 25 to 35%.
That is true. But ultimately, the problem still remains. You look at where corrections have taken place, I would broadly put them in two buckets. One is sectors where you have seen meaningful earning downgrades. So in which case the multiples haven't really corrected, right? If you look at most of the consumption-related sectors, earning numbers are pretty weak in the second quarter, and you have seen a fairly large number of downgrades across sectors over there, whether it is the consumer staples, paints, cement, auto. They have seen reasonable correction to the or downgrades earning numbers. And similarly, the other bucket of stocks where you have seen a big correction is what I call the narrative stocks, where it was impossible to understand the valuations 3 months back, and it is impossible to understand the valuations even now, despite the correction that you have seen, anywhere from 20 to 40% across the stock. So that is where the struggle is. Yes, there is correction in pockets, but either they are the back of fundamental reasons, earning downgrades and so on and so forth, or they are in a bunch of stocks where anyway you can't understand the valuations too much.
Which are these froth stocks, which you said that it was difficult to understand valuations before the correction, and it is still difficult to understand the valuations after the correction? Define froth stocks for us.
Define what?
The froth stocks. I mean, I'm using the word froth stocks because, I mean, if you don't understand the valuation, that means either it's a bubble, trouble, or a froth, right?
Absolutely. Yeah, well, I guess anything which, does not have too much of fundamentals and is trading at some ridiculous valuations. There are so many names out there. Yeah. Why do you want me to spell it out?
Getting into names, but I'm just trying to understand themes. Let's say if we can narrow it down to a theme, let's say defense or railways or solar or EV. I'm just trying to understand that where do you think markets have really run up way ahead of what the real delivery would be? Is there anything which you can identify for us which is, in your analysis, is trading at a price where the valuations or the earnings will not justify them?
I mean, most of the stuff which you talked about, look at, the multiples of the stocks with respect to the net worth of the companies. Many of those companies are trading at, if you look at most of the electricity companies, they're trading at 4 times price to book. And in most cases, the ROE is not going to be very different from the cost of equity. So why is the market willing to pay 4 times price to book for, effectively, businesses which you trade at 1 time price to book? I mean, it beats me. If you look at many of the names that you talked about, they are all trading at 10 to 15 times net worth actually. So again, what sense does it make, in the investment names in defense, etc. that you talked about?
Sanjeev, what about the fraction in the market which hasn't fallen at all? Some of the select EMS names. There have been some of the consumption plays, some of the hotel stocks, some of the platform companies, which have just not fallen at all in the market correction. Duly, you think this consumption segment is worthy of the valuations that it's quoting at, especially when it comes to some of the hotel names and some of the platform companies, namely QCom and food delivery apps?
Well, the thing is, hotel company reporting pretty decent numbers. We look at the ARR occupancy numbers, still very, very, very strong. So at least there is one segment of the, I guess, the income spectrum, which is, I guess, the high income household, which seem to be doing reasonably well, which is supporting at least consumption of certain pockets of the consumption bucket. But broadly speaking, if you look at most of the items which are consumed by the middle income or low income households, volume numbers have been very, very disappointing. You look at the car volumes this year as an example. Fiscal year to date, 3.6% retail volume numbers. Yeah. I look at many of the consumer staple companies, they're all reporting 2, 3, 4% kind of volume growth. And this is after several quarters of weakish numbers. So clearly there is a challenge in I would say decent parts of the households, namely in the middle income and low income households. Coming to the food delivery companies or the quick commerce companies, see the runway of growth is very, very long over there. The food delivery market has anyway consolidated into two players. I can't talk too much specifics over here, given we are restricted on one of the names over there. And the runway of growth is very, very strong over there, driven by more users over time, higher usage, in terms of more number of orders per user over time, and maybe continued inflation in the per order ticket size, if I can use that term, AOV as we call it. So yeah, reasonably strong drivers out here. The quick commerce market will see how that stabilizes, because you still have a lot of competition out there. But again, the runway of growth is pretty long over there too.
Taken. But Sanjeev, would you be at least positive on some of the sectors which haven't run up? And I'm talking about, let's say, cement as a matter of fact, or even chemicals, or other sectors which are even financials in that sense, which haven't run up as much. Are there opportunities within these baskets, or do you think they're of course at a discount for a reason?
No, I struggle with the valuations of the cement companies, to be honest with you. I don't understand why the market feels it is all right to give 35 PE for cement stocks. And there is no fundamental justification of that if you do a proper DCF, given the fact that these are ultimately capex intensive businesses. For every incremental volume, you will require capex to be put up. And if you look at the fixed asset turnover ratio of the businesses, that's about 1. So whichever way you cut it, any DCF model you do, you will not get a P which is more than 20 times on a 1-year forward basis. And that is assuming reasonable return on investment and so on and so forth. Chemical business looks like a good business in the long term, but the short-term challenges, never end, looks like over there. You continue to see very rapid price competition from China, inventory problems which never seem to get over. So hopefully another 1 or 3 quarters, some of these factors start to fade away. So the runway of growth is pretty long over there too. But again, the challenge over there too is that, there you have seen very significant earning downgrades, which means the valuations have stayed at very, very rich levels. So unless you see a big rebound in earning numbers, and, every quarter, the company seem to disappoint, it's very hard to, get more excited about the sector.
So Sanjeev, we were just discussing that if Sanjeev Prasad is not excited about markets, he does not like cement, he's very negative on some of these popular themes like quick commerce, EV, तो फिर करना क्या भाई? What to buy? And I'm sure clients also ask you the same. We have got some common friends, and every time they call you, they tell me that it's hard to get a buy idea from Sanjeev. Even if you put a gun to his head, he will say that gun chalao do, I don't have a buy idea. Is it true?
इतना भी नहीं है यार. Enough number of buy ideas. They've made enough money for clients who want to listen. People who want to just argue for the sake of argument, and sort of build stories out of thin air. I mean, that is their calling here. It's not my cup of tea. I'm a very hardcore numbers bottom up focus guy. If you can justify stock on a bottom-up basis, well and good. Otherwise, what's the point of recommending stocks, which you yourself are not convinced about, right?
No,
Ultimately,
Sanjeev,
we are in the business of fiduciary responsibility, and if people are not willing to, to undertake that basic responsibility, well, that is their lookout here.
No. I mean, you'll appreciate the spirit of my question here. I mean, I'm just saying that even giving the advice of what not to buy is also good advice, right? I mean, how to protect money, and if you don't lose money, I think that's also good advice.
No, fair enough.
Right. So my next question is that let's assume that India's GDP is growing in the range of about 5 to 6%. Nominal GDP means about 12 to 13%. Which are the sectors you think have potential to grow in and around India's nominal GDP? If nominal GDP is a base rate, which are the 2-3 sectors or themes you think for next 2 or 3 years will continue to grow in and around India's nominal GDP, which is 10 to 12% growth?
The issue is not so much of growth. Yeah, most sectors in India will grow. Obviously, the issue is there are two challenges over here. First of all, in the short term, you have some challenges on volume, but I'm not too fussed about that. That will eventually come back. The bigger medium term challenges are twofold in my view. One is the fact that profitability across sectors in India is very, very high. And given the level of disruption you are seeing across sectors, these levels of profitability are not going to hold up. Companies can try whatever they want, but given the fact that market structures are changing for the worse, more and more competition coming in, business modes getting disrupted by either technology or some other form of disruption coming through, the return on investment, profitability, margin, whichever we want to look at, are going to go down, which makes it very hard to justify the kind of valuation they are trading at currently. So in my view, it's a race between volume growth and profitability decline. Or in other words, earnings numbers getting diluted by possibly multiple derating across sectors over a period of time. So I think you should be prepared for in the medium term at least, even the starting point is not very great either in terms of profitability across sectors seems to be on the higher side, and valuations which are very, very rich. You should be prepared for much more modest return from the market, despite the fact that volume growth or nominal, let's say top line growth across sectors will be quite okay. There will be some sectors which will struggle, which probably much lower, let's say top line growth compared to the nominal GDP growth, which will be whatever 10, 11% kind of a number. But in most sectors, I don't think volume or top line growth is that much of a problem. The problem still remains profitability, in my view, way too high across sectors, and the multiple rating which will eventually happen over a period of time.
Okay, Sanjeev. So just to wrap it up with one more like a short to medium term kind of a thought. The general assumption in the market is that the government spending, which has got delayed because of elections, seasonal patterns, that will come back because the government A has the appetite, B the willingness, which means the second half of this year certainly will be better than the first half of this year. If that is the case, then what happens to some of these capex, government dominated stocks, which in a sense have gone through a cyclical slowdown in last 2 quarters? Can they make a comeback if government spending normalizes?
The comeback in terms of price performance, I don't know. Hard to predict. Given the fact that valuations, as I keep saying, very, very rich across this entire spectrum. So I don't think there is any dispute about the fact that second half recovery should be there as far as government spending is concerned. First half capital expenditure for the central government down about 15%. But we know the reason, right? I mean, you had government formation itself, which took the first 3 months budget, then the allocation to the various ministries, extended monsoons, all that. But the first 6 months anyway were supposed to be pretty weak. So yeah, government spending will come back, and we know the sectors also where the government is going to spend. Now the market's response so far has been, you see some positive news. There is a knee-jerk reaction. I don't think at this point in time the market is particularly focused on what exactly is priced and so on and so forth. So it's possible that the news flow is positive, the stocks will respond positively. That's the mode of the market at this point in time. And the funny thing is, the same news comes 3 times, the stock will still perform 3 times. By the way, that's the other odd thing in this market. I mean, nobody really bothered what is priced on an absolute basis, how much of order inflows need to be there to justify today's valuations. I think people are too focused on such details.
Vaman, all right, Sanjeev Prasad, really appreciate your time. Thank you for joining us.
Thank you.
And
If you like this video, then like, share and subscribe to ET Now.